Oh, it's Saurabh Mukherjea joined just now. Every time when we say HDFC Finance, HDFC Bank, Bajaj Finance, that certainly brings a lot of smile on Saurabh's face. Saurabh, before we get into what you like and where markets are headed, the general view, and this is a consensus view across the board, starting from CLSA to Citi, starting from Kotak to even, BOFA ML, that 2021 will be a great year for the economy, but it may not be a great year for stock market investors because markets have moved up in anticipation of a great earnings recovery and valuations are trading 40 to 50% above the historical averages. Do you see there is merit in this argument?
I mean, look, first off, I don't think anybody should be worrying about 1 year outlook in any stock market. I mean, if I could predict 1 year stock price movements or a 6 month stock price movements, I would have to have providential powers, which obviously none of us have. What is entirely feasible is that you could get companies, you could get breathers in the market as the stock market tries to reassess, is the economy recovering at the pace that people had expected it to recover, or is the economy recovering at the pace people expect it to recover? You could get breathers like that, but I'm not so sure I have any strong view that the market will do well over 3 years, but not over 1 year. I think that's too cute a point of view to try to take. The other perspective worth realizing is anybody who at the bottom of an economic cycle, right? We haven't even begun the post-COVID recovery properly anywhere in the world, from an economic perspective. So anybody who's trying to second guess the market at a time when the economy is just about roughing out, I think that's a very dangerous game to play. All we can do is look at fundamentals, look at results of healthy companies such as the ones you just mentioned, Nikunj, and say that from all possible indicators that we can get, macroeconomic, company-specific, a TCS or an HDFC bank, and indicators outside India, commodity prices, oil prices, interest rates, capital flows, it looks like we're in the early stages of an economic recovery. If you're in the early stages of an economic recovery, it makes sense to be constructive about the market, and it makes sense to be constructive about high-quality companies. I think beyond that, it gets into the domain of sort of, too arcane a world to be useful to any of your viewers.
What has changed in last 3 to 4 months in the portfolios of the money you manage? Has the anchoring changed? Have you added a new dimension to the way you are managing things, looking at the way how every part of the economy now is roaring?
I think the main emphasis continues to be buy great companies, clean, well-run companies. That's always been our focus in Marcellus. We've been discussing that on your channel for a number of years. The three areas where we become a little bit more focused in terms of our day-to-day research, in terms of our calling up distributors, dealers, doing more channel checks, is the whole auto ecosystem. As I think you were mentioning, implicitly implying, it does look like the auto ecosystem is humming. Both OEMs are humming. The auto ancillaries are reporting full-scale capacity utilization. My reckoning is by summer this year, both at the OEM level and at the auto ancillary level, we will get the next layer of CAPEX announcements as the auto companies will, I think, spend another 6 months with full order books, and then they will try to think about the next layer of CAPEX announcements. I think the announcements will likely come through this summer if the auto cycle holds up. Certainly in the reports that we are getting from lenders, loan dispersals both for cars and for two-wheelers are very healthy. So we're doing more work on the auto ecosystem to see what else can we buy there. The second piece is on high-quality financials. We've been long-standing fans of the premier names, firms like HDFC Bank, Kotak Bank, BAF, as you just said, have been long-standing favorites. As we see signs of a longer path to a longer economic recovery, we're going down the market cap spectrum, looking at second-rung financials, and we have made some significant investments there, such as AU Finance Bank over the last 3-4 months. We're hoping to do more investments in smaller market cap financials, because we do believe well-run financials, well-run lenders, well-run life insurers will have a great 2, 3, 4 years ahead of us. And the third piece is, in a way, looking for listed market unicorns, looking for companies which are at around, say, the $500 million mark, the $800 million market cap mark, and saying that these look like really high-quality small companies who could go on to build not just in dominant franchises in India, but potentially build globally dominant franchises. I think that's a very clear trend coming through, that well-run small cap Indian companies are being able to build globally dominant franchises. Historically on your channel, we've spoken about our holdings such as GMM Pfaudler, Alkyl Amines, but to take two other names, companies which are building globally dominant franchises, Garware Technical Fibers in Pune, in the fishing nets market, world-class franchise, Ultramarine Pigments based out of Chennai, in that specific product, and ultramarine pigments, they are the largest in Asia. So I think this will be a very interesting theme in the coming years. It could be the defining theme of this economic recovery. The coming of age of smaller Indian companies who are not that well known, building globe-girdling dominant franchises, even though their market cap is only $1 or $2 billion. I call it the sort of listed market unicorn story.
I'm just going to have an extension on the last theme, because our viewers, they love to understand new ideas. Some of our viewers say, HDFC Bank, Kotak Mahindra Bank, great, you like it, but everybody likes it. The fact that you identified a stellar outperformer like Alkyl Amines or even GM Pfaudler, what you like are manufacturing companies within the small cap space. That's a very interesting theme. Is it because of PLI? Is it because of low interest rates? Or is it because of their whole business approach where they have some IP and some advantage in terms of process and in terms of the technology they have?
That is a very fascinating point you raise, and I think it's a point we ourselves have been dwelling on for the last couple of years. Why is it that we are finally seeing smaller Indian companies come through who have return on capital well north of 20%, right? 22, 23, 24, 25%. Cash generative, smaller Indian companies don't need bank financing, bank debt, bond market debt, who have significant intellectual property, which is proprietary to them, and who are now driving consistently 20% EPS growth year after year. Why is this happening now? Why didn't it happen, say, in the 2006-07 wala boom? Why didn't it happen in 2014, 15, 16? I reckon there are three things which have played out in favor of well-run Indian manufacturers, regardless of market cap, right? Firstly, what GST has done is given well-run Indian manufacturers, regardless of industry, it's given them a genuinely pan-India market to play within. So if you sort of go outside Mumbai, if you go to Bhiwandi, just the blossoming of the logistics industry, the 3PL industry, and the outsourcing by smaller manufacturers of their warehousing, of their trucking, is a straightforward example of how GST is allowing even small companies which are efficiently run to improve their efficiency, improve their return on capital by outsourcing activities which they hitherto had to do in-house. So my reckoning is GST actually is helping well-run manufacturers, regardless of market cap, improve their cash flows, improve their efficiency levels. I think the second thing is the slide of the rupee towards the 75, 76 mark. I know it's strengthened a little bit on the back of these very strong inflows. But I think the slide of that rupee from mid-60s to mid-70s has given an efficiency kicker to Indian companies who export. It's evident in IT services very clearly, but even in manufacturing, companies like Garware Technical Fibers are big exporters, and they're clearly benefiting from a more competitive rupee. And I think the third aspect is we've now had good 2-3 years of affordable money, affordable capital. And for smaller companies whose suppliers need to be able to access capital at an affordable rate, I think we're seeing the benefits of a more affordable cost of capital regime come through. But it's a subject where we're doing more work, but it is very, very clear that for the first time in the 12 years I have lived in India, we are seeing a host of well-run manufacturers in the vicinity of, say, $1 billion to $2 billion, with really classy franchises where you can see cash flows are very strong. Franchises are underpinned not just on low cost, but around intellectual property, patents, proprietary processes, and order books are full. Order books are growing. And in fact, the biggest challenge for them is how do they grow over the next 1 or 2 years, without letting things get out of control. So it's a very promising time, I think, for efficient, well-run Indian manufacturers. Quite literally, both the domestic economy and the world seems to be their oyster.
Saurabh, budget's coming up. Are you watching out for anything this time?
So look, I mean, whilst we do watch the budget, it is something that we find interesting to watch, but we've never held great store by it, right? Because with GST there, a big part of the tax regime is no longer covered in the day-to-day budget. Plus, every state government has their own budgets. So whilst we're also curious about what will happen on 1st February, our reckoning is given the limited fiscal headroom, there's only so much the FM can do. What we are hoping is, I think if you ask us what are our expectations, the three things we would like to see continued. The PM Awas Yojana clearly has worked, right? It's evident that housing has benefited, and housing, whether anybody likes it or not, housing is a big driver of CAPEX in our country. There have been several years over the last 10 years where majority of India's CAPEX has been building houses. So we hope that the PM Awas Yojana will be continued, will be further strengthened by the budget. The second is the ECLGS program, where 6 months ago, the FM extended credit support to smaller businesses. She said if the banks go and lend to smaller businesses, the government will give credit support. I think that's been a very effective program. It would be great if the government could continue the ECLGS program at least for the first 6 months of the next fiscal. And the third thing we are hoping against hope is we don't get further taxes on the higher strata of income taxpayers. Clearly, the fiscal pressures are there on the government, but these sorts of taxes on the higher strata of income taxpayers, they don't produce that much revenue and they dampen business sentiment. So we're fingers crossed, we're hoping that there won't be further tax hikes at the top levels of the income tax segments.
Sure. Just coming back to your listed unicorn comment as well, because we're going to have a spate of IPOs, Saurabh, that's anticipated this year. I mean, we know of one like Nykaa with a massive valuation, but there are quite a few others as well that are lined up. Do you see appetite then for these new businesses, given the kind of interest that's being demonstrated and the fact that they're all now starting to mature enough to hit the primary markets?
I think there'll be plenty of money coming in. Right? From my brokerage days, many of the largest foreign investors in India are sort of friends of mine. And I have to confess, even I'm a little bemused. Even I'm a little bemused as the sheer amount of bullishness that foreign investors have. And this is not just foreign investors being bullish as an institution, that they are. That's evident through the hefty FII inflow numbers over the last 3 months, I think $10 billion each. But even personally, these foreign fund managers are investing their personal wealth in the Indian stock market in a way I haven't seen them do before. Part of it is clear, right? Part of it is because China really seems to be getting it left, right, and center from the US establishment. So the announcement last week that the NYSE was blacklisting, those 6 prominent Chinese companies, I think was a major announcement. It means that if you're a global fund manager, not just in America, you could be sitting in, say, Singapore. If you're managing American money, those blacklisted companies, those prominent Chinese companies which are NYSE listed, which were blacklisted last week, you cannot hold those, right? And obviously, no global fund manager wants to have a portfolio of stocks where increasingly the stocks are getting blacklisted by the US establishment. I think that is having a big impact. I reckon this will be the strongest year of foreign money inflows into India ever, unless something majorly negative happens in the next few months around COVID or indeed around our economy. I think this looks likely to be the biggest year of foreign inflows, and hence the point around appetite, that won't be a challenge. What we are hoping, what we would like to see is better quality of IPOs. The crop of IPOs that have come so far, barring 1 or 2 exceptions, haven't been anything to write home about. So if we get firms like Nykaa coming through, which seem to have stellar track records, appetite won't be the issue. In fact, I think it could well be that this year we have an excess of foreign capital coming in, which strengthens the rupee and causes some other challenges which we aren't quite anticipating at this juncture. But foreign inflows, I've never seen in my 12 years in India this sort of appetite. It's remarkable.
Sure. Saurabh, India kickstarted the vaccine drive over the weekend, although the numbers were a lot less meager than what one would have anticipated. About 2 lakhs, people got vaccinated over the weekend when the drive kickstarted on Jan 16th. But are you looking at any of the vaccine ancillaries, your storage, logistics, vial makers, syringe makers, anything which is likely to benefit the vaccine economy and one can look at from an investment perspective?
I think, Aisha, that'll be a little too short-termist for us to focus on. I mean, whilst like everybody else, it'd be great if all of us could get vaccinated in the foreseeable future. This is a 1 to 2 year program, right? And thereafter, it'll go on to a much lower ramp. I'm sure there might be an ongoing COVID vaccination program, much like, say, polio or smallpox and so on. But once the first big billion people vaccination is done, the scale of the vaccine program will ebb off. Secondly, as with most of these public health vaccination drives, it's a little difficult for companies to make very high returns on capital because it's such a high profile issue. To generate a hefty return on capital given the public health interest is obviously it's a poison chalice, let me put it like that. So both it's a short-term revenue jump for the vaccine providers. They deserve those revenues for doing what we are hoping they'll do over the next year for the rest of us. But on a discounted cash flow valuation of a pharma company, a 1 or 2 year jump in revenues doesn't actually mean that much. And then further, there is the public health consideration to keep in mind.
What is it that you're making, Saurabh, of the spree of disinvestment chatter now from the government stable and the OFSs as well, which have been announced off late? Material yet, you think, to take a relook at the entire disinvestment process and maybe look at PSUs, or would you say let them materialize and then one will take a call?
So I remember last year, 1st February, I stood in your studio and you asked me what will happen to disinvestment. I confidently said record announcements will be made by the government on disinvestment. The announcements were made. Obviously, because of COVID, they haven't been able to fructify on that. Look, the government has little choice, right? The fiscal position is difficult. The government is right to try to use these buoyant capital market conditions to sell as much as they can. I think they will once again announce in the budget record disinvestment numbers. Can they pull this off? Right, that's become the recurring question over the last 10 years. Can this investment be pulled off? I can't but help think that some sort of incentive has to be announced by the government for the incoming buyer to buy these assets. Right. OFS is better because you're selling minority stakes, but minority stakes are only going to fetch you so much. If you really want to privatize, and I think the government does want to privatize, the government needs to privatize more actively, then I think some sort of kicker has to be given. Either a relaxation on labor laws for privatized companies or a tax break which makes it sufficiently attractive. I can't but think that without a carrot, this privatization program is not going to take off, and that'll be a shame because we do need to privatize from whichever angle you look at. So in the budget, if we could get a carrot which incentivizes, say, sovereign wealth funds or large Indian companies to go forth and take the risk and buy a PSU, it'll be great to see that. We do really need to get this privatization drive moving, and as yet the signs are not quite there that it will move.
Saurabh, I want to go back to that concept of or the whole thought of internet companies going public, whether it's Nykaa or whether it is Policy Bazaar or whether it is Nazara Technologies. This is the hottest global theme, whether it's digital or whether it is companies which are essentially in the e-commerce business. If we are on course to see 4-5 companies in India going public from the so-called e-commerce in the digital space, what it means for other IT companies. Up until now in India, the only way to bet on the digital wave is that you buy TCS, Infosys, Wipro. Could that change? Could that change at a very broader level in terms of fund allocation also?
Yes, so I think it's a lovely question you posed. So in a way, this is chalk and cheese, right? TCS, Infosys, HCL Tech, they are IT services providers. The resemblance between them and, say, if you look at the listed companies such as, say, Naukri.com, InfoEdge that is, or say Intermesh, there is really no similarity. There's two completely separate industries. Now, if you look at the internet companies, as you put it, Nikunj, and InfoEdge has shown you and me that by building a monopoly franchise in Naukri.com, and full disclosure here, we have InfoEdge in lots of our portfolios. InfoEdge has shown over 20 years now, best part of 20 years, that if you build a monopoly franchise like Naukri.com in the recruitment classified space, it generates lots of cash flow. And if you can reinvest the cash flows as Sanjeev Bikhchandani Saab and his team have done at InfoEdge, if you can reinvest those cash flows successfully in businesses such as Policy Bazaar, such as Zomato, you can actually create a very powerful virtuous engine. What we worry about is it's not clear to us how many other franchises of this quality there are in our country. InfoEdge is a super franchise, both in Naukri franchise and the capital allocation skills of Sanjeev Bikhchandani, Hitesh Oberoi and team. It's not evident to us that India is blessed with lots of other franchises of this quality. If we do see more coming through, and Nykaa sounds promising. I haven't, I've only seen them from the outside as a customer, or rather, I've watched my wife be a big customer. A Nykaa box seems to rock up in our house every week. But if we get more franchises of the quality of Naukri, of InfoEdge, and Nykaa sounds encouraging, then I think clearly it is a very positive portent for the Indian stock market. Funding availability already seems to be quite abundant. Funding availability for the internet companies seems to be quite abundant thanks to India's very, very active venture capital space. What was missing so far, until at least India Mart came through, what was missing so far is the stock market being an exit point for the venture capitalists to exit. So India Mart and hopefully Nykaa will now get that trend going. And we in the stock market will also start benefiting perhaps from some of the best VC investments in our country.
Okay, just to wrap it up with a not a tricky question, but something which I've been thinking. In the near term, do you think there is scope for HDFC Limited to do much better than HDFC Bank, simply because we are at a revival in the real estate market and the data is suggesting that?
So clearly HDFC Limited benefits from not just holding HDFC Bank. They have HDFC Asset Management, which we also own in some of our portfolios. They also have HDFC Life, which we own in some of our portfolios. So I think HDFC Limited's greatest strength is they have inside there, and they hold major stakes, majority in the case of two of those companies and a minority stake in HDFC Bank. They hold, big stakes in three of India's best run financial services companies, each of whom is dominant in their industry. I think HDFC Limited's greatest strength is that, yes, the housing market recovery does play favorably for HDFC Limited, but it's worth keeping in mind that giving home loans to, say, people like you and me is no longer a very profitable activity in our country. The spreads after taking account of operating expenses and NPAs or provisioning costs, the spreads on lending to people like you and me, for anybody, whether it is for SBI or for HDFC, the spreads are quite small. And therefore, my belief remains that HDFC Limited's greatest engine is the fact that they've got these fabulous assets inside, which are themselves compounding engines, which we and Marcellus benefit from. The housing market revival is good to have, but the must-have, so to speak, if anybody in India can have three franchises of this strength, HDFC Bank, HDFC Asset, and HDFC Life gunning away from them, I think that'll be probably one of the sort of nicest things to get in Indian finance. And HDFC Limited, through their hard work, through Deepak Parekh's judgment over the last 30 years or so, have built these three magically powerful franchises, which they will obviously reap the benefits for many, many years.
Well, I appreciate your time and certainly hope to see much more of you going forward.